Hi guys, welcome to Gold Today. This video is brought to you by the coach. Remember always our job is to make you rich. If you are a new subscriber, welcome aboard and thank you for joining us. If not yet, please hit the subscribe button. We are going to start our video with the economic calendar. On the economic calendar for Monday and from the United States, we will be waiting for the federal budget balance for the month of July. That's all for the economic calendar. We will have a look now at the numbers. On the last trading session of Friday, we have had a trading range from 1494 to 1508. Numbers are rounded and the market is closed. Gold spot printed a closing price on the last trading session Friday above 1496. Gold is trading in a bull trend above its all daily simple moving averages, and as you see, the 20 days daily simple moving average is about 1442 and the 50 days daily simple moving average is about 1414. For the RSI readings, we are overbought on the weekly and monthly and daily charts with readings 83, 72 and 71 respectively. For the support levels, it's 1494, 1483 and 1476, and for the resistance levels, it's 1508, 1518 and 1527. That's all for the numbers. We'll move on now to the trading strategy. Since it's the weekend video, it's going to be longer than usual, and we will try to spotlight on one of the most important indicators of the financial health of the economy and financial markets. We are going to talk about the bonds market, the falling yield, the negative yield, and the yield curve, and the inverted yield curve. Sit back and relax and grab yourself something to drink. We are going to talk about really such an interesting topic. For the definition, a bond is a financial security by which the issuer of the bond is owing the holder of the bond an amount of money which will be paid when the maturity of the bond, which is the period of holding, is completed, along with an amount of interest is agreed upon. The bonds usually or mostly is used by governments and corporations. It's not for the personal or individual use, and the majority of the demand for the bonds comes from institutions like banks and pensions, and the retail market does little influence on this area. Government bonds are perceived as safe havens because the government is going to pay you your money no matter what, and used for hedging purposes and for the yield that it generates over the holding period. Bonds have initial issuance like an IPO, and the secondary market where those bonds are traded between the investors. That being said, we need to understand that there is a difference between the bond price and the bond yield. The bond price or the price of the bond is the price at which the bond is exchanged on the secondary market, and it has so many perspectives when it comes to calculations. And the bond yield is what an investor could perceive or receive, on a given period of time as interest payments during the holding period. There is a negative correlation between bond yields and bonds prices. If a price or the price of a given bond goes up, the yield on this bond will go down, and if the price goes down, the yield on this bond will go up. That's how it works. What we have seen recently of falling yields is caused by the state of panic that stormed the markets. Investors have been buying bonds at a premium for its safe haven appeal, accepting less yields just for the sake of safety, since the government will always pay its debts. Interesting, isn't it? Now focus on this, please. Higher interest rate means higher discount rate, means higher bond price, and as a result, lower yield. And lower interest rate means lower discount rate, means lower bond price and higher yield. The US dollar and the US equities have positive correlation with the yields. and that's why dollar is trading on the sideway, though the yield is though the US dollar is in a rising cycle. Gold has a negative correlation with the yields. That's why gold is trading on the highs, because the yield is falling. There is a tool called the yield curve, which shows all the maturities from 1 month till 30 years, and you have to understand that the short-term bills, by design, it has less risk and typically higher price and lower yield. At times, the yield curve inverts, by which the short-term bills yields becomes higher than the yield for the longer-term maturity bills. It has inverted actually in the last 40 years for 7 times, and each time it inverts, it signals a recession, and the recession happens. So why an inverted curve, as we said, is not a good sign, because investors are pushing the money to the longer term hedging tools or hedging tools and avoiding the short term tools or financing tools. This is from the government perspective. It's point for how much the markets are in panic, and as a hint, the falling yield cannot be fixed overnight. You need the government to interfere by lowering the interest rate or doing something else. A resolution in the market is needed to push the yield higher. Finally, I would like to mention also one more thing, that the size of the bond market is 15 trillions, and you have to. Something makes me really worry, that a quarter of this market is paying negative yields. Imagine I beg you to borrow from me $100, knowing that you are going to pay it for me 90, and I'm so happy. I don't see that there is a problem for gold trading around 1500. This chart show you the spread between the 2 years and 10 years treasury bills, and as you see, it's about to invert, and if it inverts, it's going to signal a recession. Back to our subject. On Friday, I sounded a little bit confused. My last video, I said jump in, then I sent a message through the Telegram to revise my video, saying that both gold and silver could be dipping into a correction, because they were failing to capitalize on weak dollar and weak equities. Here I say I believe that the market of gold and silver won't fall, but it could go through an intraday correction. Gold spot developed a support zone from 1458 to 1445. It's a buy blindly zone with a stop loss below 1442. I'll be stunned to see gold trading below 1450. Also, gold formed three tops at 1507, 1509, 1510. A break of this level is a buy signal. This channel can be stretched out to 1587 if fundamentals held. I hope after all this long detailed explanation may help you understand why confusing at times happens. In my opinion, avoid shorting unless it's on the highs, and buy any worth of $25 or more, and buy both gold and silver on that dip. Always keep a long position opened in the market in your portfolio. You will never know what is going to happen in the market. Thank you guys for watching. I'll see you tomorrow in another video.